Now we'll cover the concept of net domestic product. So as I have explained you what is GDP, it is the gross domestic product. When we make certain adjustments, certain deductions from the gross figure, we arrive to the net figure. So to calculate net domestic product, we will have to subtract, we will have to adjust back the depreciation allowances. Now here, before we get into what is depreciation, why we need to deduct depreciation allowances, we should know what is depreciation. So if we understand the concept of GDP, it is the value which is being added to the nation. So depreciation is one element which reduces the value of various assets. Depreciation is a continuous reduction in the value of assets because of its usage. So at one point of time, at one side we are adding value to the nation, whereas because of depreciation the value of assets is going down. So to get the net figure out of the gross figure, we will have to subtract out the depreciation allowances, and by doing that we will derive to the net domestic product. Next is, we'll move on to the gross national product. So here the difference from GDP and GNP is that the word domestic has been replaced by national now. So now we will have to understand what is the difference between the domestic and the national figures. So if we define gross national product, it can be defined as that gross national product is calculated after considering the contribution of non-resident producers in the form of wages, rent interests, or any investments made to the economy. For example, again taking India as a reference to the Indian economy. So gross national product is defined as the sum of gross domestic product and the net factor income from abroad. So net factor income from abroad is again abbreviated as NFIA. We can symbolically present it as that GNP is equal to GDP plus NFIA. Net factor income from abroad is, like for example, it is the State Bank of India, which is operational in any other country. It has its branch in London and it has certain saving accounts in it, and it is generating revenue from that branch. So that revenue will be added to the total revenue of State Bank of India, and this income, as it is generated in London but generated through an enterprise which is a resource which is a part of Indian government, so that will go in the kitty of, that will go in the account of, in calculation of GDP of India. So once to the GDP of India we add back that income, that revenue which has been generated by State Bank of India London branch, which is NFIA, which is an example of NFIA, we will get the GNP, which is gross national product. Now after calculating gross national product, we will again have to convert it into net national product. Again the basic concept would remain same, that net national product is calculated as a sum of domestic product and the net factor income from abroad. So what we are doing here is, again to the NNP, to get the NNP we are adding NFIA to the net domestic product. So now we have calculated net national product. Net national product is from the domestic product. If we add the NFIA, we get the net national product. Now again, as we have calculated GDP at the factor cost and the market price, again it is required to calculate all the parameters, whether this is GDP, GNP, NNP, NDP, at two different criteria, which is market price, which is current price, or which may be factor cost. So now we can sum up that if we want to define national income is nothing but the net national product calculated at the factor cost. So here we can say that the national income is the net national product calculated at factor cost. Again, to get the NNP at factor cost, we will have to do certain adjustments in the net national product, which is calculated at the current price or the market price. So again, we would add back the subsidies if it is related with any product, and we will subtract the implication of taxes from the net national product, and then we will get the national income. In other words, we can say that national income is also calculated as FID plus NFIA. So here I would like to explain that what is FID. FID is the factor income from domestic territory. Again, factor income from domestic territory is like, if we again raise the example of State Bank of India, that all the branches which are situated within the Indian territory, within the domestic territory, that will contribute to the FID, whereas the London branch of SBI will contribute into NFIA, which is net factor income from abroad, and adding these two we will get the national income. So here we have understood the concept of national income. But again, national income is, what is the utility of calculating national income? The utility of calculating national income can be understood if we further divide it into its parts. We understand that what are the different components of national income. The two main components of national income are personal income and personal disposable income. So personal income will comprise of that portion which an individual, or which is saved or invested by the individuals in country, that comprises of the personal income. Whereas personal disposable income is that part of money, that part of income which is disposed, which is spended towards purchasing any commodity, and this is the actual fuel which gear ups, which ignites, which catalyze the you can say the economic growth, or the manufacturing activity, the corporate activities of any particular country. So discussion of national income would be incomplete without comparing GDP, gross domestic product, on international levels. We need to make an international comparison of GDP, that whether we have calculated GDP, is it sufficient to explain the economic health of a country, or whether we need to do a comparative study of a health of a country by calculating the PPP. Now the concept of PPP, which is purchasing power parity, comes in picture. So what is purchasing power parity, and why we need to calculate this, why we require PPP? So as we know that internationally, when we judge the wealth, the strength of any country, we need to convert the value of their currency, or whatever is the reserve with that particular country, convert it in the international currencies. But again, with respect to the currency which is getting converted into the international currency, the exchange rates keep changing, it keeps fluctuating. So what we can say, that why we need to make an international comparison of GDP is that to get the estimation about the living standard of various countries on an international level. So again, as I have stated, that the exchange rate of currency across the countries are not stable. So converting GDP only in the US dollars would give misleading results. So now another method is that the checking of standard of living of various countries is by calculating the purchasing power parity, which is a method which adjusts the different relative prices across the countries before making comparison in common currency, right? So in other word, national income, if calculated at factor cost, it is called as purchasing power parity. And another fact about purchasing power parity is that India is the third largest economy as per the purchasing power parity across the countries of the world, right? So these are the basic concepts which one should know before getting into the details of calculation methods of calculating national income, that what are the various steps through which we can derive to the concept of national income. But before that, we would have to be convinced about that what is the use, what is the importance, what is the utility of calculating national income. So if we explain the utility of national income or in terms of importance of national income, we can say that the calculation of national income provides an estimation of national expenditure, which is further divided in consumption and investment. Like the individual incomes earned by the citizens of a country is either consumed or whether it has been invested. So this power of consumption, the increased power of consumption of the individuals would again gear up the corporate activity. The more we'll consume, more corporate is motivated and gets the reason to manufacture products to provide services. So it is actually helpful in, if we have more consumption power, more disposable income, it means it is an indication for the corporates to be on their toes related to the higher production levels. The next purpose of estimating national income is that it provides the structure of economy by calculating the income from different sectors. When we are calculating GDP, we calculate that how much different sectors are contributing, like banking sector, manufacturing sector, education sector. So through this we can get to know the individual contribution of different sectors into the national GDP. Calculation of national income is also helpful in estimating income distribution in the country. As we calculate the national income, which further helps to calculate the per capita income, and broadly we know that higher the per capita income, richer the country is. So by calculation of per capita income, we will get to know that how rich is the country and which classes are having more better standard of living or more power of living a lavish life. The estimation of national income is also helpful in forecasting the growth and contribution of different economic sectors. It helps in comparing the public sector performance with the private sector performances. So that ways we can set the benchmark, we can set the bar by making a comparison, by setting a competitive benchmarks between the two sectors. So which will help further the private sectors to raise their bar, looking at the public sector, and public sector further to raise their bar, having a comparison with the private sector. Calculation of national income is also helpful in comparison of living standard across the nations. As once we calculate national income, we will be able to calculate the purchasing power parity also, which is an indicator of comparison of living standards. Now it is also helpful, the national income is also helpful in collecting data for poverty and productivity across society and economic sectors respectively. So these are the reasons, I think these are sufficient enough, good enough to have a detailed understanding about that why we should calculate national income. Now coming to the methods of calculation or methods for measuring the national income. So far as repeatedly I have used that there are goods and services which have been manufactured. So one element of national income is flow of goods and services. The other element is generation of income. So another element of national income is flow of income. The last but not the least is how much expenditure has been done to actually raise those products or actually provide those services. So the next element is the flow of expenditure on goods and services. So looking at these three elements, these three components of national income, we can derive three methods in which we will focus on each element of national income, and these methods will name as the first method, which focuses on flow of goods and services, as the product method or the value added method, because it is based on what value has been added by different goods and services. The second method is by calculation of income, and hence it is named as income method. And third method is the expenditure method. So in the coming slides we'll take it further in detail. Thank you.